Today we are going to discuss on a very interesting and useful topic called Technology Optimization for Smooth GST Compliance. The session flow and objectives: the GST, the game changer. Knowledge is power. The most common GST returns, which is GST R3B and GST R1, both from GST law perspective as well as automation perspective. Tally as a software for GST compliance, the existing handy features available in Tally, and the expected features which can add more value for GST compliance, areas requiring human analysis because machine can never replace humans in entirety. There would be a requisite amount of human analysis which would be required. The optimal mix of automation and human analysis for businesses. Documentation trails for the returns. And finally, matching of credits, which is part of the proposed GST returns. What is the way ahead? GST, the game changer. We all are aware that 1st July 2017 has been a very historic moment. It has been the biggest fiscal and economic reform since India's independence, that is the introduction of Goods and Services Tax Act. We can call it as a mammoth reform indeed. Why it is called so? Because it subsumed most of the indirect taxes like the sales tax, the value-added tax, entry tax, luxury tax, entertainment tax, excise duty, additional duties of customs, central sales tax. Likewise, the government envisioned the dream of GST being a one nation, one market, one tax. The benefit of introduction of GST is, the biggest benefit of all is the free flow of credits. Earlier, the credits of one law was not available for the credits in another law. Goods related credit were not entirely available for the services. Similarly, vice versa. But with the introduction of GST, there is a free flow of credits which is available, of course, subject to certain exceptions and conditions. The other important feature of GST law is online compliances, ensuring transparency as well as accountability. Let us all appreciate the fact that GST is a compliance-driven law being introduced from 1st July 2017, having experienced the return filing and the various other compliances under GST all through. We all would agree to this fact that GST is a compliance-oriented law. Compliance demanding timeliness, compliance demanding accuracy. Both being the aspects which require compliance in time as well as accurate manner, we have to actually see how best this objective can be achieved with the optimum available resources. Knowledge is power. I'm sure all of you would agree to this. To have a smooth GST compliance, two things are quite very important and predominant: knowledge of the GST law and knowledge of the technology for possible automation. Both should go hand in hand. And that's why today's discussion is on technology optimization for smooth GST compliance. When we say technology for GST, the functionality of the GST portal, that is our Goods and Service Tax network, this is also equally important. Usage of softwares. Today, hardly we find any businesses without using any software. Why so? Changing demands, accounting compliances, return related compliances, reconciliations, and also the MIS related reporting. All this would be required, hence usage of softwares has become more or less very much inevitable in today's era. Let us understand the basics of returns. What is a return? Return, to be more specific, a tax return is a form filed with the taxing authority that reports income, expenditure, other pertinent tax information. Tax returns allow the taxpayers to calculate their tax liability, to schedule their tax payments, and also ascertainment of refunds if any. So this is the purpose of a tax return. Now coming back to GST returns, basically the most commonly filed returns are the GST R3B, which is a monthly return presently for all, and GST R1, which is a quarterly return in case of persons, registered persons having aggregate turnover of below 1.5 crores, and in case of the other category of persons, it's again being monthly. Now let us understand this concept of GST R3B as far as the GST law is concerned. GST R3B has various segments which is in the form of tables. The first and second tables are more of the general information as far as the GST number and legal name of the business is concerned. We have the third table, which I would like to call more as a liability table, because it captures the information pertaining to my liabilities both related to outward supplies along with the liabilities related to my inward supplies, that is my reverse charge liabilities pertaining to inward supplies. So then we have the 3.2 table wherein interstate supplies to unregistered persons requires reporting. Table 4, one of the very critical tables for as far as input tax credits is concerned, there is a detailed subdivision of the input tax credits in that table. Table 5 is all about my exempt, nil rated and non-GST inward supply reporting. 6.1 is the payment of taxes and 6.2 is my TDS or TCS credit. This is the GST TDS or GST TCS credits. We all are aware that from 1st October 2018, the TDS and the TCS provisions were brought into effect. So thus, table 6.2 is my credits which are available wherein the other person who is liable to do the TDS or the TCS has deducted it and furnished the relevant returns. Thus, I will be able to claim those credits as part of my cash ledger, which is 6.2 of GST R3B. Now, general instructions before filing GST R3B. Whenever we are reporting the supplies or the taxable supplies, we need to take the value of the invoices plus the debit notes, reduce the credit notes, and also add the advances on which I am liable to discharge tax the moment I receive the advances, and also advances adjusted, wherein previously I have paid the advance and this month I have raised the invoices. So these adjustments needs to be done, and on a net basis the same needs to be reported. Here you find the tile summary of GST R3B as is available in the GSTN portal. Now, if we look at table 3.1, as I call it, the liability table, there are 5 sub-tables in that wherein there is a classified data which we need to report therein. The first table is called the outward taxable supplies, other than my zero rated, nil rated and exempted. Outward taxable supplies basically pertaining to all my domestic supplies on which taxes are applicable. It includes both intra, that is within the state transactions, as well as inter, that is outside the state transactions, that is between one state and the another. And the implications would be the CGST, SGST in case of intrastate supplies and IGST in case of interstate supplies. The second table is a very important table as far as exports are concerned. The proper reporting of the export related information has to be done in table 3.1b, which is called as the zero rated supplies. There is 2 possibilities in case of exports. One is exports with payment of duty and the other one is exports without payment of duty. In the first case, I would be exporting and IGST would be paid, as well as then I would be claiming the refund out of it. In such a case, I need to report the IGST part also over here, because this is a very critical aspect. The matching with the IceGate portal, which is the customs portal, happens via this particular table. Once the matching is effectuated, the refund processes happen. The other outward supplies, that is my table 3.1c, here I need to report the nil rated as well as the exempted outward supplies. Now, what is the difference between the nil rated as well as exempted? Some of the goods or services has been granted exemption in the public interest by the government. Such goods or services could be located in Notification 2/2017 as amended from time to time in case of exempted goods, Notification 12/2017 again as amended from time to time in case of services. Whatever the entries are found in these two notifications is a subject matter of exempted goods. Now, what is nil rated in such a case? In the Notification 11/2017, which is the tariff schedule for the various taxable services, there are a couple of entries which are marked as nil rated entries. One example is serial number 16 and the other is serial number 24, which pertains to some agricultural support services. So, in a taxable tariff schedule, there are certain items which are marked as nil rated. So, those are called as nil rated. So, but on a large scale basis, if we may think so, most of the products and services which are exempt would actually be under the exempted category. Now, we have this inward supplies liable to reverse charge. Difference between what is a reverse charge and forward charge. As far as this segment of GST reporting is concerned, all my other information is pertaining to outward supply, just this 3.1d which pertains to inward supplies and the reverse charge compliances with respect to that. We also have non-GST outward supplies. It is interesting to know that nowhere in the law the term non-GST has been defined. It is only found in the returns. However, what we find in the law is non-taxable supplies, which is for time being the alcoholic liquor for human consumption and also the petrol related products, the petrol, diesel, aviation turbine fuel, all those 5 products related to petroleum. So, most of the people have been reporting these kinds of outward supplies under 3.1e. Let us spend a little time over here to understand what is meant by a forward charge transaction as well as a reverse charge transaction, because this is one of the talked about provisions under GST, the reverse charge mechanism. As far as forward charge is concerned, if I am a purchaser, I purchase certain goods from a supplier, let's say worth of 1 lakh rupees, on which tax is around 18,000 rupees. The supplier charges that 18,000 on the invoice. I pay to him 1,18,000. This is called a forward charge transaction because that 18,000, whatever he collects from me, he acts like an agent and he deposits it with the government. Thus, in a forward charge, there is a supplier who acts as an intermediary between me and the government to discharge these taxes and pay to the government. On the other hand, in case of reverse charge, that intermediary is removed. It is my inward supply. I only directly pay to the government, and if eligible, I would definitely claim those credits back as well. So, thus, in a reverse charge mechanism, the recipient of the goods or the services will directly pay those taxes to the government. It is interesting to know that there are 2 categories of RCM or the reverse charge mechanism. One is an RCM of notified goods and services, most popularly called as the 9(3) or the 5(3) RCM, 9(3) for intrastate and 5(3) for interstate. The other category is RCM for unregistered procurements. Whenever a business procures certain goods or services from unregistered vendors, so there was this compliance which was required, which was effective from 1st July 2017 up until 12th October 2017. 13th October, a notification was issued exempting this category of reverse charge transactions from payment of reverse charge, that is this unregistered procurements. However, the CGST Amendment Act has come into effect. So, there is a primary question in everybody's mind: is RCM under section 9(4) or 5(4) back in action? Well, as we just discussed that CGST and IGST Amendment Acts 2018 have been notified. In fact, it was published in the official gazette on 30th August 2018. However, the same were notified with effect from 1st February 2019. Now this bigger question which is there in the minds of many of the people wherein whether RCM under 9.4 or 5.4 is back or not, the answer is yes, but subject to a small asterisk, that is which we need to understand what it is. Since this provision is notified, we have to understand whether there are any changes in these provisions. In fact, if we look at the CGST and the IGST Amendment Act, there has been a substitution of these provisions. The old 9.454 are different and the new 9.454 are different. How different are they? I would call them 9.4 or 5.4 RCM is back in a new avatar. The new avatar requires fulfillment of twin conditions for applicability. 1. Specified class of registered persons. 2. Specified category of goods or services or both from an unregistered person. The good news is, this category to apply, it has to be notified by the government, and no such notifications have come yet, but we may expect in the near future to come. Once these provisions, these categories and goods are notified, goods or services are notified, then again RCM under 9.4 and 5.4 would be back in action. So, understanding this about the second category of 9.4 and 5.4 RCM, probably we can relax for a while. However, we should not forget that the other category of RCM, which is called the notified goods or services, that is under section 9.3 or 5.3, were there, is there. So, let us see which are these categories. I have given you a snapshot of the 8 category of goods which have been notified up until now, and we also have the services notified wherein the reverse charge is applicable even as of today. There are some 15 items in the services. We would be discussing on those RCM services which would be most common to most of the businesses. One is the GTA services. So, the GTA services, again there are 2 possibilities here. A forward charge, if the GTA himself is doing a forward charge at 12%, then no worries. If not, then there is a RCM implication on the recipient. Similarly, this legal charges or the legal services given by the advocates, that also is a subject matter of RCM. Again, the sponsorship services, then some of the services received from the government. One has to be very careful that whatever payments go to the government are not exempt per se or not out of purview from the GST per se. There are so many transactions which might trigger an RCM implication on payments made to government. We must be aware of all these things. One example could be a royalty paid to the government. So, likewise, another RCM entry was introduced way back in January 2018, where a registered person, if he is occupying any premises of the government wherein on a rental basis, then he is required to discharge RCM on that. Similarly, services given by the director of a company, like the sitting fees paid, those things will have again the reverse charge implications. And another one which very recently got introduced, that is with effect from 1st of Jan 2019, is the services provided by security personnel. One should be very careful. It is only limited to the extent of security personnel only, and not the general manpower supply services. So, from 1st of January 2019, whatever services have been provided by way of supply of security personnel is also under the purview of RCM, subject to exception that if such services is provided by a body corporate, then it would be under forward charge. Similarly, there are 2 other exceptions wherein if such service is provided to a composition person or to a person who is registered only to do the TDS compliances, then in both such cases it would be a forward charge transaction. Now, understanding this gist of the transactions which require RCM, So let us quickly get back to see where this needs to be reported. So here we have 3.1D, wherein inward supply is liable to reverse charge. All these transactions, if they have happened in my business, then these would require the reverse charge compliances. Coming to table 3.2 of GST R3B, here I am supposed to report the B2C IGST turnover plus the composition plus the UIN, that is the unique identity number holders like the embassy, etc. This needs to be reported state-wise. The very important concept under GST, the eligibility or ineligibility of input tax credits. Again, a very critical area to understand. Table 4 of GST R3B dwells in detail about this provisions. We have table 4A, which is subsegmented into 5 subtables, that is 4A1 with respect to import of goods. I may have imported certain goods. It could be my inputs or it could be even capital goods like fixed assets. Both needs to be reported over here. Only the credit part, if I have paid any IGST at the time of bill of entry and I have received goods into my business, then I need to report it over here. Import of services. Like we were discussing the RCM provisions, there are 2 more entries in notification 10/2017 with respect to RCM interstate, and which pertains to a few transactions of it pertains to imports as well. Whenever an importer incurs ocean freight, then there is a provision under this notification that he needs to discharge RCM on this ocean freight. Similarly, whenever there is a service which a registered person receives from a person outside India based on the place of supply provisions, then RCM could trigger even on my import transactions, even on my import of services as well. Thus, if there are any RCM implications, I would be reporting over there in my 3.1D table, and the corresponding inputs I would be availing over here in 4A2. The next part is the 4A3, wherein other than the imports of goods as well as import of services, all other RCM which I am doing, that I need to be reporting over here. We should note that RCM could be a CGST, SGST RCM or an IGST RCM, depending on again the place of supply provisions. There is another concept called input service distributor, wherein the common services are provided to the head office along with all the other branches. However, invoice is raised in a particular state. In such a case, invoice needs to be raised on an ISD registration, and he in turn distributes this credit to the other recipients or the distinct persons, basically meaning the same PAN multiple GST numbers. Thus, if I have received any such ISD credits, I would be reporting in 4A4. And one of the most familiarly used table portion of table 4A is the 4A5, that is all other ITC. Whatever other ITC apart from the 4 aspects discussed as of now, everything would come under the all other ITC. There is this part wherein we need to do the ITC reversals based on eligibility or ineligibility criteria. We will discuss this in a little detail as it is quite important to do all these compliances. Coming to the another important aspect of input tax credits, that is the reversal of ineligible credits, which we call the common credits, and also the reporting of other ineligible credits. We will dwell through this as we proceed with the presentation. As far as input tax credits is concerned, we should understand the 5 terms with respect to input tax credit: available, eligible, availed, utilized and allowed. Available. Firstly, to check whether an input tax credit is eligible or not, it should be per se available. Then we check the eligibility criteria. I will be discussing on the various conditions which would be required to see whether a credit is eligible or ineligible, and availing it. How do we avail? The way we file the return, through the return, GST R3B. Even in past we would have availed the Tran 1 credits, that is by filing the returns we avail the credit. What is utilization? I would have availed a 1 lakh credit this month, but I would have required only 80,000 to discharge the tax. So that 80,000 is called utilization, and balance 20,000, it would be available to me in the electronic credit ledger as unutilized credit, then allowed. So going with the assessments, whatever the credits which we have claimed, it will get transformed into final credits and finally be allowed. Now, what are the conditions for availing this input tax credit? Firstly, if we examine section 16, there are set of conditions which are prescribed for the eligibility of input tax credit. The possession of the tax invoice, debit notes or such other prescribed documents like the bill of entry or the ISD invoice are per se basic requirement to avail the input tax credits. Receipt of goods or services is also a criteria to be fulfilled. Tax must have been actually paid. So whatever is available is only available as a provisional basis ITC. Return must have been furnished. That is, the assessee should have filed the return to claim the credit. Another important criteria for eligibility check on an ITC is whether payment to the vendor has happened within 180 days. This is one of the conditions laid down in section 16. If the payment is not happened within 180 days, then one needs to reverse that credit along with the interest at 18%. However, the same is paid after that, then he can re-avail that credit, but there would be definitely an interest repercussion on this. This needs to be checked. There cannot be a double benefit for any amount per se. Thus, if one is availing depreciation, then he cannot get the input tax credit benefit. Thus, either depreciation or ITC is available. So, we will have to again examine with respect to capital goods whether the eligibility criteria, what are the eligibility criteria and how to go with the compliance. And another important thing is the last date to avail input tax credits pertaining to a particular financial year is the due date to file the September return of the following year, which is generally October 20th as of the existing due dates. However, 2017-18 being the first year of implementation of GST, government has passed an order called Removal of Difficulties Order, order number 2 of 2018. According to this order, if any of the credits have been missed out availing within the time frame allowed, that is, in fact, for the last year, September 2018, the due date was extended to October 25th. If somebody did not avail any such credit, they can still go ahead and avail that credit within 31st March 2019, provided the same is got reflected in GST R2A. This benefit is available with a condition tied with it. So, let us be careful of it, and if possible, then we can definitely go ahead and avail the missed out credits. Now, other conditions which are required to avail an input tax credit, we need to refer to Rule 36. One is the very critical aspect, which is the GST of the supplier as well as GST of the recipient must be present on the invoice to have the eligibility. The other details would be the amount of tax charge, the description of goods or services, and the total value of supply of goods or services, and place of supply if in case of interstate supplies. All these fields should be present in an invoice to avail my ITC. In fact, the above proviso was inserted to sub-rule 2 of Rule 36 on 4th September 2018 via the notification number 39/2018. There are certain credits, even though if they are used for business, but they are blocked or restricted. The most common blocked credits are the motor vehicles related credit. In fact, the CGST Amendment Act has clarified that except for the cases mentioned therein wherein such motor vehicles are obtained either for the purpose of further supply of the same motor vehicles or for training purposes or for the transportation of goods and the passengers subject to the restrictions specified therein. Otherwise, the motor vehicle credits are not available. Further, the vehicle insurance, repairs All such expenditures wherein there is a GST element, those credits are also not available, which has been clearly spelled out in the CGST Amendment Act. Such other blocked credits list would be the food and beverages, beauty treatment, membership of a club, rent a cab, life insurance and health insurance. Except these three items, only if it is mandated for an employer to give this, then only he can avail the credit. Otherwise, these credits are not available on a ad hoc basis. Then the travel benefits extended to employees like the leave or home travel concession and works contract related services, like if I get a factory building constructed and if there is a GST on that, then I would not be eligible to take the credit because it was one of the blocked credits if it is capitalized in my books of accounts. Similarly, tax paid under composition scheme is not available as a credit, and we have other credits like the personal consumption or goods are lost, stolen or destroyed or written off or disposed by way of gift or free samples. So, if we have a write-off in our books of accounts, we should ensure that we have reversed the corresponding ITC. Similarly, whenever tax is determined by a tax officer later, or in case of e-way bill provisions, if the goods are detained, seized and then any tax and penalties are paid, all these payments again are restricted credits, hence one would not be entitled to claim those credits. Now, ITC reversal, a very, very important concept, wherein we need to refer to Rule 42 for in case of inputs and input services, and in case of capital goods, we need to refer to Rule 43. The concept of free flow of credits under GST needs to be understood. It's a chain action, in fact, wherein the flow happens. However, once the taxability gets cut, meaning once there is exemption under GST, then the flow of credits also gets cut. Similarly, the credits should be used only for business purposes. If any of the credits are used for non-business purposes, then one cannot get those credits. So, all these details are beautifully laid out in Rule 42 and also in Section 17(2). So, to understand, they classify the credits with giving some codes for that. Once we understand the logic, we would be very easily able to do the reversals and the compliances. So, whatever the credits are available, we can broadly classify them into 5 categories. The tax element can be divided into 5 categories. Okay. The first category, exclusively used for non-business purposes. If I say I buy a mobile to gift to a family member, although there is GST, although my GST number is there, all other conditions satisfied, still I won't be eligible to take the input tax credit of it because it is not used for my business purposes. Similarly, if I have a business wherein I deal with exempted products, so then in such a case, the credits which pertaining to my exempted class of business, then I won't be eligible to take those credits. Those are called as T2 credits. We just discussed so many blocked credits. Despite being used for taxable purpose, despite being used for business purpose, are certain credits which are called blocked or restricted. The examples we discussed, the motor vehicles, the food related, factory building related, all those credits would be called as blocked credits and they have been given a code called T3. However, if I use exclusively for my taxable purpose or for my zero rated which is my export related, then I would be eligible for full credit, which is called the T4 credit. I would also have certain administration expenses wherein the same services or the goods I would be using both for my taxable supplies as well as exempt supplies. In such a case, those are called as the common credits. So, we have non-business purpose credits called as T1, exempt purpose credits called as T2, blocked credits called as T3. Despite being used for business and taxable, these would be blocked. Then we have exclusively for taxable and zero rated, that is exports, called T4, plus we have common credits which is called as the C2 credits. Now coming to the availment of credits. Since my T1, T2 and T3 are ineligible credits, that is my non-business related, exempted related and blocked credits, I am not eligible at all. Hence, I should not claim any of these credits in my return. So, now coming to the T4 credits, which I am fully eligible. So, these credits I can avail, but as far as common credits are concerned, which is my C2 credits, I need to do a reversal in the proportion of my exempt turnover versus my total turnover. That is what it means. If I have an exempt turnover of say 10 lakh rupees and an total turnover of say 1 crore rupees, then 10% of all my common credits, I should identify my common credits, invoice level and do the reversals in this formula. So, in this case, in the example I took, there is a 10% C2 reversal which I need to report in table 4B1, which heads as rule 42 and 43 reversal. This is the rule 42 which we are talking. Suppose I have a mobile bill credit which I have availed. That mobile bill, I am using that mobile phone, I am using for both for my business purpose as well as my personal purpose. So, this again is a common credit, but since it is used for non-business purpose, I need to do a 5% reversal of my entire common credit. Thus, this is called the D1 and D2 reversals as envisaged in the rule 42. I think if we take a practical purview, this concept is more easily digestible. So, till now we conceptually discussed about what are the eligible credits and ineligible credits and how to reverse. Probably taking you through this mock P&L account, wherein the various P&L heads have been identified and tracked to my GST R3B will give us a better understanding of how these reversals needs to be done and what needs to be reported where. If you look at my outward supplies, we will start with the outward supplies. I have sales of various rates. I also have exempt sales. So, this will give me an indication whether at all any reversal is required at the outset or not. Let us say an example wherein I have only taxable supplies, then there is no question of, there might not be any question of common credits and the corresponding reversal. But in the given case, we see that there is an exempt sales, there is also non-GST sales or the non-taxable items over here. Hence, this is definitely a case which would call for my ITC reversal. Similarly, we have the debit notes and credit notes, all the transaction examples which we have given and corresponding information as to which table of GST R3B it would come in. When we look at the P&L account, we need to expand our review, just not limiting to the trading items but also to the P&L items, where we will look into all the indirect incomes as well. It could be my FD interest, which is an exempt outward supply, that also needs to be reported. The corresponding table is 3.1c. Similarly, I might have a rental income, that also needs to be reported, and it could be a commission received or an incentive received. So, all my credits in the P&L account, whether it is in my income side or as a credit in my expense side as well, it could trigger a GST implication. It could be a possible outward supply. Hence, I need to report on all these things in my GST R3B. Now, coming to the credit eligibility analysis. I have various goods or services which have different rates of taxes like 5, 12, 18 and 28. So, all these purchases are my fully eligible credits. Hence, I would classify them as T4 credits. Then I have my debit notes, in which case that is also an eligible credit, where it is the original value compared to the original value, there is an enhancement in the value via the debit note. Hence, that also I would be eligible. As far as credit notes is concerned, it could be a goods return case or a value difference or a rate difference and all that in line with section 34. In such a case, there would be a reduction in the credit. This we need to be very carefully see, because there are a lot of credit notes which might be issued. The corresponding reversals needs to be taken care. It needs to be reversed under the section 4B2 of the GST R3B, which is my other reversals. I would have some direct expenses like the packing expenses or the carriage inwards and all that. I need to look into whether it is pertaining to my GTA services. If it is received from a GTA and he is not doing a forward charge of 12%, then I am supposed to do a reverse charge at 5%, and based on the purpose again, I need to classify my credit. If that hiring is exclusively for taxable purpose, I would classify it as T4 credit. If it is exclusively for exempt purpose, I would classify it as T2 credit. If it is common for both, then it would be my C2 credit. Likewise, I have given an analysis of various ITC in my P&L account heads. The shop rent paid being used for both taxable as well as exempt, thus it would be a common credit. And my salaries, it would be a recon item because there is no GST implications, it being the Schedule 3 item. So likewise, we also have this refreshments head. The refreshment expenses, it's a blocked credit, food related expenses, hence I would classify it as my T3 credit. With respect to bank charges, the loan processing charges or the check processing charges, the conditions needs to be taken care if is the invoice available, have they uploaded, have you given your GST number. Subject to all those things, I may take all those credits. Likewise, we need to analyze each of the ITC as to whether it is a fully eligible credit, whether it is a fully ineligible credit or it is a common credit calling for the reversals. Once I am done with this analysis, now I would arrive at my exempt turnover and the total turnover. Then I would sum total my C2, which is my common credits. Then I would do a D1 and D2 reversal, which is, as we discussed, based on the proportionate way of my exempt turnover over the total turnover. Also, let us remember, this reversal is not just monthly. Although we do it month on month basis, on the year end, we should arrive at the summated C2s, summated exempt turnover and summated total turnover and recalculate the final D1 and D2 reversal for the year and give effect accordingly. If we have excess reversed, then we will add it back, or if we have less reversed, then we will reverse back again along with interest. So that is how we do the credit analysis based on the eligibility criteria envisaged in the provisions of the GST law. However, I am also required to see my balance sheet. I cannot limit my review only to P&L account because there could be a sale of fixed asset, there could be a purchase of fixed asset. Suppose my business is exclusively taxable supplies dealing business, I should happily go ahead and take my capital goods related credit because it would be fully eligible credit. I can take the entire credit in the month of purchase subject to the condition that I have received that in my business. So if we take the example of a pharma industry wherein the outward supplies consist of both taxable supplies as well as exempt supplies. Let's say a pharma dealer purchases a refrigerator to store the medicines. He would use that to store both taxable as well as exempt. Hence, it becomes a common credit. In such a case, how would I arrive my eligibility? I need to take the credit in the month of purchase provided I have received that into my business. However, I should treat the life of this asset as 60 months, that is 5 years, and I have to keep track of every asset purchase like this, and I should reverse in this ratio of E bar F, that is exempt over total turnover for 60 months along with interest. So beware while availing the capital goods credit whether at all it is feasible to avail such credits and keep the track of this, and again reversing it with interest is all review and cost benefit analysis would be required before claiming the capital goods credit, especially when there is both taxable as well as exempt supply in our business. Now coming back to this other reversals. So we understood the input service and inputs common credit reversal. We also understood the capital goods related reversal whenever it is a common credit. As far as my GST R3B is concerned, I would report my ITC reversal under two segments. 4B1, which is about my Rule 42-43 reversals which we discussed till now, and 4B2, which is about my other reversals. One would be my 180 days payment criteria. If I do not pay within 180 days, then I need to reverse along with interest. That needs to be reported over here. The other is my ISD credit related reversals. Then few more could be my purchase returns, which wherein there is a credit note which has come in, so that reversal, or any other ineligible credits which I earlier availed and owing to my circular 26 I am reversing it now. So, all such reversals can pitch in table 4B2. Then we have this 4D, which is only a reporting table but will not have any impact on my calculations per se. Again in table 4D, there are two segments, 4D1, which is about my blocked credits which we discussed, that is the T3 credits. Then we have 4D2, which is my other ineligible credit. One would be this T1, which is used for non-business purpose, T2 used for exempted purpose, and also other ineligible like I do not have the GST of the recipient on the invoice, or owing to place of supply provision like the accommodation bills of other states. All these could be a subject matter of this 4D2 where I am reporting my other ineligible credits. Now, table 5 of GST R3B deals with my exempt, nil rated and non-GST inward supplies. Again, there is a categorization of interstate as well as intrastate. We should be mindful that while reporting not merely the purchases of goods but also all the services wherein there is no tax implications would require reporting in table 5. Then interest and late fee. With the experience we have seen that late fee, which is 20 per day in case of a nil return and 50 per day in case of a tax payable return, will be auto-populated based on the number of days of delay in filing the return. However, interest needs to be voluntarily complied by doing the calculations by ourselves. So, even section 50, which deals with the interest provisions, explicitly mentions that one needs to make voluntarily the payment of interest. Thus, I will have to figure out the interest repercussions in case of delayed filing and report here accordingly. Of course, the pay the same. Till now, we understood the GST R3B, the law requirements and the detailing of the reporting which is required, the reversals which would be required, all of this. Now, let us understand the GST R1, which is my outward supply return. Basically, there are 13 tables in GST R1. I would say GST R1 is more of submission of classified data in the returns. Like I need to bifurcate and submit the details based on whether the recipient is registered or unregistered, based on the products or services dealt by me is taxable or exempt. Again, whether I am supplying it directly or through an e-commerce operator. Further, rate wise bifurcation, is it a 5%, 12%, 18%? Invoice wise bifurcation, in case of B2B and also B2C large, I need to do a invoice wise reporting. There are few segments wherein I need to report advance related tax payments and also the adjustment of the liability through that. So, table 11 exclusively deals with that, and also the credit notes and debit notes issued along with the amendments. The one beauty of GST R1 is it allows amendments of most of the tables along with most of the fields. Any errors which would have occurred while filing the return, all could be amended using the GST R1 amendment tables. However, there are 3 tables on which amendment is not possible. One is my table 8, which is my exempt outward supply, table 12, which is my HSN summary, and table 13, which is the documents issued during the period. There is no amendment provisions in the GST R1. So, this is a quick run through of the GST R1. I am sure we have been filing GST R1 since quite long, hence we will quickly brush through this. Table 4 is more about invoice level reporting with respect to the registered person. So, B2B transactions gets reported over here. Table 5 requires reporting of B2C large. B2C large means when I make a supply to a person situated outside my state and the value of such supply exceeds 2.5 lakh rupees, then again I need to report invoice wise. Then we have the export related reporting. One is the with payment of IGST or without payment of IGST, that also needs to be reported, and my shipping bill, the port code or the bill of export, all these details needs to be reported over here. This is a very critical table, especially when one is going for the refunds with respect to exports, the data should match with the IceGate portal data for the smooth refund process. Similarly, we have supplies made to SEZ unit or SEZ developer and also the deemed exports. All these are treated as a deemed zero rated supplies, hence that those reporting also is a subject matter of table 6. Now table 7 we have B2C small. Here we report rate wise reporting of the various products and services state wise. So I can put it like this: state wise, rate wise reporting. Here while reporting B2C small in table 7, we do a net of credit notes and debit notes reporting. So then table 8 is with respect to my nil rated, exempted and non-GST outward supplies. Here we have again a 4:3 matrix wherein I need to report which category it belongs to, whether it is nil rated, exempted, non-GST, again further segregated into registered persons, intrastate, registered persons interstate, unregistered persons intrastate and unregistered persons interstate. See, these reporting all could be automated and which could be a hassle-free compliance. Otherwise, manually collating all this information will take so much time and efforts. As discussed earlier, there is scope for amending each of the field in the GST R1 related data, and most of the tables could be amended if there are any errors which was filed as per the previous data. We can make the amendments using table 9 as well as table 10 for both the invoice level as well as the consolidated rate wise reporting using the table 10. The table 11 is for advances related submissions, wherein those advances, like on services, if I receive any advance today, still it is payable on advances, meaning at the time of receipt of advances itself I am required to discharge taxes in case of services. Thus, I will have to discharge that using this table 11 reporting, plus I can, once the invoice is raised, those advances will get adjusted, and that adjustment also is a subject matter of this table. HSN reporting needs to be done in table 12. Firstly, if my aggregate turnover for the preceding financial year is below 1.5 crore, there is no requirement for HSN reporting. However, I should report the description of such goods or services. If my turnover is more than 1.5 crore, up to 5 crores, it is 2-digit reporting. Above 5 crores, it is 4-digit reporting. We must be careful. For deciding this criteria of 1.5 crore below or the threshold, what needs to be considered is my preceding year's aggregate turnover. The various fields which requires filling in HSN is my UQC, that is my unique quantity code, the total quantity, value, taxable value, tax amount, IGST, CGST, SGST, cess, all these bifurcations needs to be provided in my table 12. Then we have the document summary, wherein what all the documents issued during a particular month, from to, if any cancelled, that also requires reporting, and also the net issued. So basically we will have for our outward supplies, which is our sales or service provided, all those series requires reporting. The series should be within 16 digits, a slash and a hyphen are the allowed characters, otherwise numbers and alphabets are allowed. Then whenever I do an RCM compliance, there is also an additional documentation compliance which is required. If the reverse charge related inward supplies are supplied by an unregistered person, along with doing RCM, I have an additional liability to raise something called a self-tax invoice, because for any credit one avails, there should be an underlying supporting credit document. That is why a self-tax invoice has been prescribed under section 31(3)(f) read with rule 46. Thus, one needs to raise a self-tax invoice that needs to be reported over here. Then in case of revised invoice, that is a newly registered entity, within 30 days the requirement being arising for the registration, he can issue revised invoices because he would not be knowing his GST number. Only for the limited purposes such revised invoices could be issued, but not otherwise. One needs to be extremely careful with respect to this. Again, the debit note and credit note series, these are all pertaining to my outward supplies. That is what debit notes and credit notes I issue as a supplier and not those pertaining to received as a recipient. Receipt voucher, whenever I receive any advance which is taxable under GST, then I am supposed to raise a receipt voucher. I need to report the same over here. It should not be confused to the regular accounting receipt vouchers and the accounting payment vouchers. What needs reporting over here is only GST related receipt vouchers and also the payment vouchers. What is this GST payment vouchers? Whenever I make a payment pertaining to an RCM vendor from whom I have procured certain inward supplies subject to RCM, I need to issue a GST payment voucher in accordance with Rule 52. Then I need to report the same over here. The section reference is section 31(3)(g). Then we have the refund voucher. If an advance is refunded, then we can issue a refund voucher, and the same requires reporting over here. One point which we must be aware that any movement of goods should be substantiated with a document. It could be a tax invoice, it could be a bill of supply. If it is for purposes other than supply, then it could be even a delivery challan. The delivery challan also has further 4 categories. If it is issued for job work, then compulsorily we should have a separate series. If it is issued for supply on approval basis, again a separate series needs to be maintained. And if it is for liquid gas, a separate series required. However, if it is any other purpose than this, then like it could be the line sales, it could be like exhibition, demo purpose. If for these purposes, if the goods are moved, then it could be one consolidated series for all these categories. All these document series needs to be reported in GST R1 table 13. Thus, this is the summation of what information needs to be given in GST R1. So, this is the detailed and meticulous way of reporting requirement. Now, looking at the GST returns from the automation perspective, use of softwares have become inevitable for every business. Hardly we find any businesses without softwares today. The reason being, the volume of transactions are high, the veracity of transactions, and there are a lot of e-business models, and business requires a lot of key information which is highly powerful for them. So, they would be requiring the MIS reports. All this being the cases, and another important reason for having a proper software is the statutory compliances which require in-time and accurate compliance. However, multiple softwares have been giving support to businesses for as far as GST is concerned. Ideally, softwares are used firstly for the accounting purpose, return related compliances, reconciliations. We have number of forms which are there, GST R3B, GST R1, the auto population in GST R2A, now coming with the annual returns GST R9 and 9C. More the number of forms, more reconciliations would be required, checking it back with our books of accounts and all this. So, even for this purpose, softwares are available and being used, and as discussed, even for the MIS reporting with respect to GST as well, the softwares would be required. Tally has been one of the most popular accounting softwares, but with GST pitching in, Tally has given a lot of hand-holding and support as far as GST implementation as well as compliance is concerned. The existing handy features of Tally I would personally appreciate is the GST validation. The moment you configure a party ledger with a particular GST number, it has an automatic validation which will check from the portal and say whether that GST number is right or not. That's really a handy feature. Secondly, we have multiple level configurations available, like be it the party ledger configurations, be it the stock item configurations, or be it the company level configurations, or even overriding at the transaction level. These features are available in Tally, which makes it very, very flexible. Either I can decide on the optimal mix of ledgers I would require. The other feature which is quite handy is my mismatch reports and the support for corrections in the returns. There is a inbuilt GST reconciliation report which comes in Tally, wherein once we access the statutory reports and go to the GST R3B or GST R1, there is a specific sector which I would be taking you through, where we can review if at all there are any mismatches, so that the same could be corrected and rectified, and then the returns could be processed. However, few more features are expected, with which the compliances can be more easier as well as smoother. Some documentation support is expected as far as the self-tax invoices with respect to the RCM inward supplies and also the GST payment vouchers are concerned. And the GST R2A, the hot cake everywhere, the reconciliations, the challenges with it. If this feature is being provided by Tally, that would be really a very great measure. Then also the annual returns, although the due dates got extended till 30th June 2019, yet compiling information manually would really lead us to a very Herculean task. If that can be brought about in Tally itself, that would be great. What I get to learn is all these are there in their upcoming versions of Tally. That would be really good if that can happen. As an accountant or a business owner, I would be concerned that my return is submitted on time to avoid any late fee and interest repercussions, and it is complete. There is nothing missed out in it and it is correct. That is, the returns furnished are accurate. Now, technology for GST. The purpose of technology is firstly prevention at the source. Any errors that could occur should be prevented at the entry level itself. Detection. Suppose an error has occurred, that has to be detected by the system. Once that error is detected, it should give scope for correction. Once that correction happens, compliance can be smooth. Thus, the configurations, the recording of the transactions and the reconciliation at source, and finally it will lead to ease of filing of the return. Let us see the configuration part. Company setup. As discussed, Tally allows multiple level configurations. If I am a company dealing with a single rate, then I can configure at the company level itself at a single rate, and whatever transactions I record automatically, unless I configure it otherwise, it will pick it from the company level configuration. Then I have the master setup, the party ledgers. It could be my vendor masters or my customer masters. So the configurations that would be required as far as GST is concerned is, one is the GST number along with the choosing of whether he is a regular registered person or he is a composition registered person or he is a consumer with no GST. All these choices are available in a party ledger configuration. Similarly, the country and the state, so that to decide whether it is an export or an import or a within the state, that is the intrastate or interstate. These configurations are quite critical. There could be vendors having multiple branches in different states. So one needs to be cautious while configuring such vendors, wherein two ledgers would be required with proper state and country configuration. Then we have the stock item configuration, wherein I can configure my stock, one with the tax rate, and also the HSN code can be fed into the configurations of the stock itself, wherein it will ease my reporting for GST R1 as well. And also it will, it can be reflected in my invoices also, because the moment my turnover exceeds 1.5 crore, there are these HSN related compliances. Then the tax ledgers. So that under the category of duties and taxes, we have multiple tax ledgers. Here again, either I can choose to have a single ledger called CGST, SGST, IGST, I mean to say, for both outward output as well as input, or if I require so, I can again bifurcate into output CGST and input CGST based on my requirement. Now, the recording part. So I choose the party ledger, I choose the stock item, then on clicking of the CGST ledgers, either I can have a rate-wise ledgers or I can have a common ledger. If I have a common ledger called CGST, based on the stock category, the value of tax would be automatically picked by the system. Suppose in a single invoice, if I have multiple tax rates, no worries, I can have a single ledger called CGST, but the tax calculation will be automated by the system, and also the same can be printed as to the GST analysis. That feature is also available. Suppose if I make an error while recording here, I have selected Ganesh Trading Limited, which is a registered person in Karnataka. I am also a supplier in Karnataka. then if I select IGST, then the system will prompt saying that right type of tax is not chosen. However, if I choose the CGST and SGST, the same would be validated and accepted. So, the right type of tax and the right rate of tax both are taken care here. If any error or mismatch occurs, the system will prompt. Reconciling at source. This is one of the very interesting and beneficial feature which is available in Tally, wherein once we enter all the transactions, I get a reconciliation report in my statutory reports. As you can view from the screen, I see that in this part there is incomplete or mismatch in the information to be resolved. There are 10 items. Here the system is detecting the errors wherein it reads and understands from the ledger configurations, and all those errors come and sit over here, because even though at the entry level itself the system prompts, I can still override that. Once I override such alerts, it will come and sit in the mismatch over here. So let us see what category of mismatches could be there. One is country and state details not specified. If I have not given full information regarding my party masters, that could be one of the mismatches. Tax rate not specified. So if I haven't specified the tax rates, then also it could come as a mismatch. Mismatch due to tax amount modified in voucher. So as per calculation, that is that 18%, whatever it picks, there is a figure which is coming, but I override it to make that figure different. It was coming as 99,998. I just made it 1 lakh rupees just to have that rounding off. So it is an overriding of the calculation. Hence it will say that mismatch due to tax amount modified. Vouchers with incomplete or incorrect details. Suppose in case of an export, I have not entered my shipping bill details or the port code details, then it will say that the information provided for the returns is incomplete. Once I resolve all these issues, then the mismatch will turn into 0. Then I can peacefully conclude that my, the data, whatever I have keyed in is all the data has flowed into my returns, whichever is relevant. Of course, wherever, in the slides to come, I would be discussing what are the details which would come here in not relevant for returns. See, out of the total vouchers available for the period, the system will classify whatever is included in the returns, whatever is not relevant for the returns, and also the mismatches. We should check for these mismatches and also check whether any transactions which are relevant but have been got included in not relevant for returns owing to the configurations issues. We will see it in a while. Once this mismatch is the 0, then I can safely conclude my return is ready. So the validation of transactions would happen. The system will detect the exceptions. Seamless correction, that is, system will assist me. I can trace back to those transactions and edit them and make the corrections, and finally I would be filing an accurate return. Now, ease of filing the return. Once this mismatches is resolved and it is return ready, then I can generate a JSON file from Tally, because all the returns related files are in the format called JSON, that we can save it in our computer and log into the portal and upload that particular JSON file. On uploading, the system, the GST and portal will validate the JSON. If any errors pop out, then it will pop out those errors in the JSON which is generated for the error file. We can check that and recorrect and submit it back. Otherwise, if there are no errors, we are ready to go with the JSON file generated from Tally, and we can file the return and done with the compliances. Thus, using technology, there is ease of filing, there is speed and efficiency, plus there is accuracy. This is the benefits of automation and embracing to technology. How do we enable the GST configurations in Tally? As we discussed earlier, there is a company level configuration which is possible. We can enable GST in Tally and do the master setup the party wise, inventory wise, income and expenditure ledger wise, and the duty ledger setup, all these things. And as far as the transactions is concerned, we can broadly classify it as sales related transactions and purchases related transactions. So we use the F11 feature, statutory and taxation, and enable GST over there. Then we can set or alter the GST details as displayed on the screen. So we key in the state details and our GST number and other configurations which are available if I am an entity wherein the tax is subject on reverse charge like a GTA service provider. I can click here right away so that all my transactions get recorded therein. So the rate setup hierarchy. How the rate setup hierarchy goes is, if I have set up a rate at a company level, that would be the first level. If below that I do not specify anything, the system will automatically read that. Next, there is an inventory level rate setup. Suppose I have set up particular rates for only few of the inventories. There are 10 items. For 3 items I have mentioned the rates. For other items I have not mentioned the rate. The system will pick it based on the company configuration. That rate will be auto picked. The third is the accounting level configuration. Suppose I do not use a stock item, but I only use a ledger. I can even configure the ledger to a specific rate, which will be the overriding rate than the previous 2 rate setups. Finally, at the transaction level also, let's say I have configured a printing and stationery ledger at 18%, but now I have a expense which is at 12%. If I wish not to have a separate ledger for again a printing and stationery at 12%, I can override at the transaction level and accept yes. However, it will sit in the mismatch, then I have to say accept as it is, and thus it can be translated to the written data. So this is what we were discussing about the various configurations that would be required at the company level, that is my GST number, rate, HSN and whether reverse charge. At the inventory level, I would configure the item name, rate, HSN and UQC, which is my unique quantity code, like the number of units or bags or pieces. Likewise, even at the accounting level, I can configure the ledger name with the rate and the HSN as well as the UQC. At the transaction level, I can override my tax rate. I can also override my HSN. This will be a handy feature for composite supplies, wherein only for that particular transaction I need a change of the HSN. So all this flexibility is available in Tally, and I can even do a multi-rate tax configuration over here. Say I can create a group wherein all the stock items created under that group will come under a specific slab, say 12%. So automatically, based on the group level configuration, the system will pick for the items over there. Likewise, I can add a subgroup as well, and I can also add individual stock items with a nil rate. However, if I specify something at the individual level, that will override the group level. Now, unique quantity code, there is a set list of unique quantity code in line with what is available in the GSTN portal. However, as a business necessity, I might be using a UQC which is not there in the portal. So, for that matter, even in the drop down list, I can name and create an UQC as I want and again link it to the available list. So, that feature is also available. As discussed, we would also require the tax ledgers. Again, if I want more control, I can use separate ledgers called output CGST, output SGST, output IGST and input CGST, input SGST and input IGST. This would lead to a better control, because whenever there is reversals, there will be a credit in my input ledger. But if I use a common ledger, then there will be an issue with respect to a credit. Is it pertaining to output or is it a reversal of input? So, it is a business call to take as to how many ledgers you want. So, the groups and ledgers, basically the supply would be classified into outward supply as well as inward supply. Again, in the outward supply, the sub-classification or the multiple classifications which would be required based on the categorically whether a particular transaction is taxable or exempt, whether interstate or intrastate, whether it is a registered person or an unregistered person procurement. Now, deciding the optimal mix is a point of reference I would draw over here, because for deciding the optimal mix, we should trade off between two things. One is ease of data entry versus ease of return filing. Let's say I do not want to have multiple ledgers for a single category of expense. I only want to have single ledger like I used to do before GST. Even after GST, I want only one ledger for each expense. I can still do that. But however, while filing returns, I'll have to do a comprehensive review of all the transactions and decide eligibility, ineligibility, registered, unregistered, and all those things I need to take care with that, since I use only a single ledger. One example I would like to quote with respect to single ledger is carriage inwards. We have to do a trade-off between the ease of data entry and ease of return filing. If we have minimum number of ledgers, it will be very easy for data entry, because the particular ledgers, anybody can pick from those ledgers and do the data entry. However, while filing the returns, I would require a comprehensive review as to classify it based on which table to fit in, whether it is reverse charge, forward charge, all these things I have to take care at the time of return filing. If I use maximum ledgers, let's say for each category, I have given a small example wherein a carriage inward can be a group of ledgers almost nearing to 10 ledgers, like GTA forward charge 12% intrastate, GTA forward charge 12% interstate, non-GTA, that is a person who doesn't issue a consignment note, that would be exempt again. So intrastate, interstate. Likewise, for a single carriage inwards ledger, I can have multiple 10 ledgers. But imagine the complexity of a person doing the data entry. He should analyze and choose the appropriate ledger. If that is missed out, again it would go for a wrong reporting in the returns. That is why I am required to do something called as an optimal mix decision. So what is the optimal number of ledgers that can be done? So carriage inwards forward charge, carriage inwards reverse charge, carriage inwards exempt. This could be the three ledgers would be sufficient enough to give the return related information, because the moment I do a carriage inwards forward charge, and based on the vendor, the system will decide whether it is an interstate or intrastate, whether it is a registered or unregistered. However, reverse charge and forward charge has to be separately configured. So configuration fundamentals. Whenever we are doing a configuration for a particular ledger or a stock item, there are three possibilities: GST applicable, GST not applicable, GST undefined, meaning I am not doing any configuration, system will say undefined. Whenever it is applicable, there are further configurations which are available as discussed: inter, intra, RD, URD, taxable, exempt. If taxable, multiple rates again, whether RCM, whether ITC is eligible, and whether it is non-GST, all these multiple configurations are available. However, in certain transactions wherein there is no GST repercussions, there is this dividend income, salary payments, I would choose as not applicable. It will go and get reflected in not relevant for returns. Similarly, GST undefined, that is where I have not done any configurations, that again will go and sit in my not relevant for returns. We should review the category of transactions getting reflected in not relevant for returns to check whether any configurations have been missed out, so that there is no incomplete data being furnished in the returns. So once we select a particular ledger, if I want to have a specific ledger category, then in the nature of transaction over here, I will have to select from the available list over here. Suppose if I do a not applicable, then I can manage with a single ledger. System is intelligent enough to read based on my vendor whether that transaction is an intrastate or the transaction is an interstate invoice. So this the system is capable of doing it. Hence I can still have a single ledger and still do a return related compliance. In case of a bill to ship to model, I would require two addresses to be mentioned. One is the billing address, the other is the shipping address. There is an F12 option. Once we go to the sales invoice category and do an F12, we can tick on the option which says allow separate buyer and consignee names. Once we do that, we can generate an invoice with a bill to ship to model. Now, as discussed earlier, if I want to have multiple rates related sales ledgers, I can still do that, wherein I will choose here as nature of transaction as sales taxable. This means it is within the state transaction, and choose a rate of 12%. All these are independently selectable. Similarly, in case of exempt, I can have as sales exempt, that is an intrastate sales exempt. If I want a separate classification for interstate sales exempt, I can still go ahead and do that. As discussed, we have to always ensure an optimal mix of the number of ledgers for ease of data entry as well as the return related compliances. In case of exempted supplies, we are aware that bill of supply needs to be raised. In case of taxable supply, tax invoice needs to be raised. We can configure a separate series for this kind of an invoice. I've given an example of FD interest received from bank, which is a exempt supply in fact, and we need to raise a bill of supply even for this, along with grossing up of TDS if any done. We were discussing that in case of reverse charge inward supplies, we would require generation of a self tax invoice if the vendor is unregistered. So owing to section 31(3)(f. So how do we do this in Tally? Presently, this is a requirement which is put across to Tally, probably expecting this in the next version to come. But right now, we may use the optional voucher which is available in Tally, wherein for such invoices, I would generate this, and this we can get in exceptional reports, and I have to manually enter this in the GST R1 report under table 13. So, I've shown few examples of 9.3 RCM and also 9.4. This was for the period 1st July 2017 till 12th October 2017, wherein I can issue a monthly one consolidated self-tax invoice. This again we have used an optional voucher. Similarly, we need to raise a GST payment voucher for all the RCM related payments to the vendors for each of the payment done. This is as per section 31(3)(g) read with rule 52. So, this again we have configured as a optional voucher. Again, request has been given, probably the same would be considered. As I said, dividend received is an transaction on which GST is not applicable. Hence, I would select a configuration called not applicable over here. So, coming to the inward supplies again, we have the whole list of nature of transactions which is available. I would reiterate, either I may choose not applicable over here. If I am using accounting with inventory in Tally and stocks are configured with the rates, then the system will automatically pick the rates based on the stock items. However, if it is a ledger, it's only an expense without having any inventory impact, I can still use a not applicable and allow the system to recognize based on my vendor so as to the registered part as well as the place of supply part. I can even override at the transaction level. So, let us say if I have any import of services, then I would select an import taxable, and owing to the reverse charge provisions, if it is applicable, I would select whether reverse charge applicable as yes over here. So, like we discussed earlier, we can have 3 ledgers for the GTA related transactions, that is my carriage inwards. One is a forward charge, one is a reverse charge, as well as the other one being an exempt. We can manage with these 3 cleanly without any hurdles for the return related compliances. However, if we require to have multiple ledgers, we can still have. There are these few screenshots which have been shown over here. So, recently the security personnel related services got notified for the RCM related compliances. So, that is one of the configurations which have been shown for that particular service. So, again there are multiple rates related configurations which could be done. If it is exempted, we can still select exempted. If I have a fuel related expenses, it is treated as non-GST goods, hence I have to enable it as non-GST goods so that it will get reflected in my table 5. As far as salary is concerned, it is a not applicable item because it is a schedule 3 item, whereas there is no GST implications. Coming to the refreshments, here we can select it as ineligible credit yes, so that it will come to my reporting in table 4D. So these are my blocked credits, hence I will choose my input tax credit eligibility as ineligible. Now, despite all this automation, there is an element of human analysis and hence manual compilation would still be required. One is with respect to my creditor aging related reversals along with interest, which means 180 days criteria. Of course, Tally has a feature which will show me the creditor aging for the number of days I show. Based on that, I have to again manually comply to see whether how much is the amount of ITC I need to reverse, also along with the interest calculations. Again, the common credit reversals which we discussed, that is the D1 and D2 reversals, that needs to be manually done, and other reversals, be it my purchase returns related or my ISD related reversals or YTD, that is my year to date common credit reversal, or some other wrong credit availed earlier now being reversing, all this have to be manually kept a track and done the reversal. Interest calculations again needs to be manually done, and the amendments, any changes are required or some errors occurred while filing the previous return, all these things has to be manually done. This is how we look at the creditor aging analysis. We go to display statement of accounts, outstanding and payables. There we can F6 is the option where we get the age wise. We can select more than 180 days and then we will get the party details wherever it is more than 180 days and below that. In fact, it would be ideal to do a check of more than 150 also, so that whatever payments are pending to be made, it could be cleared so that next month reversal could be avoided. Now, this all features being available and most of the data can be return ready to be filed. However, it would be very prudent to maintain the document trails month wise. We have this statutory reports which is available in Tally. This is what I was discussing, wherein the number of vouchers during the period and how much is included in the returns and how much is not relevant for the returns. All these things I would get over here. Here we can see that there are no mismatches, meaning all the transactions are fine. Thus, I can take an Excel export of all these reports over there. This is the summary report. Either I can view it written format or as voucher format. I can get both of it, and I can drill down further table wise: 3.1a, 3.1b, 3.1c, 3.1d and 3.2. Likewise, table wise drill down I can do. I would insist personally we can export all this information into multiple sheets in Excel, which can be a wonderful document trail for every month, so that I'll have a handy information, not just the summary details, but each detailing of the drill down reports is available based on which I filed the return. This would definitely be handy during the time of assessments. Similarly, I have taken a snapshot of all my input tax credit related table, that is my 4A, 1, 2, 3, 4 and 5, which we can export to an Excel file and preserve it for future reference. This is the blocked credit list which is available as per the configurations. Then we have this table 5, which is this exempted, nil rated and intrastate, interstate, based on the configurations or and the recording of the transactions. If anything is overridden at the transaction level, the report would be available over here and then the drill down would be there. So similarly, the non-GST supplies as well, the drill down report of that. So this is the mismatch which is there, so which we need to resolve. On drill down of that mismatch report, we will come to know mismatch in the nature of transaction and place of supply. So the party's country is not properly configured, that is why that mismatch is popping out. So once I clear that, the mismatch will be nil. Here specify the nature of transaction, taxable value and tax rate. There is transactions are not defined per se, or the value and rates are not specified, thus it would be popping this mismatch report. There is another feature at the voucher level entry wherein I can enable supplementary details for the transaction to specify each of the transaction as to a particular category, whether it is a interstate, intrastate, all that is available. I can use that as well. So this is the mismatch with respect to the tax value. So this is the summary report of GST R1. Again, this can be viewed as voucher wise or as party wise, both are available. I can use the drill down reports here as well, and then take a trail of all these transactions to be preserved for my future reference. Now, one important thing to be noted here is table 13 of GST R1 in Tally. It will display all the vouchers configured over here. So, we need to be noting on it and be careful whether only those which are relevant for the returns are being displayed over here. Whatever the debit notes and credit notes issued by the supplier per se should only be reported here. Again, accounting receipt vouchers and accounting payment vouchers should not come here. Only the GST payment vouchers should come over here. Thus, as discussed earlier, we have this optional vouchers which we have used that needs to be manually compiled over here and reported. So, here again we see the mismatches. So, the reasons for mismatches will be displayed. On resolving, then the mismatches will be 0. Thus, once all the mismatches are resolved, we can generate the JSON from Tally and save it in our system and import that JSON file into the GSTN portal and then upload it for a hassle-free return compliances. Certain provisions of CGST and IGST Amendment Act have been notified with effect from 1st February 2019. There is also some of the provisions which are yet to be notified. One important and impacting provision on almost every business is the envisaging of the matching concept of the ITC. So, we have somebody's purchase should definitely be a sales as reported by another supplier. So, matching of input tax credits the way forward. As we come to the concluding part of this session, definitely the move by government is going to be beneficial from the national interest per se, because input tax matching is definitely essential. However, thinking from the practical perspective and the daily or the monthly compliance perspective, it could be a Herculean task if this matching is going to be put upon the taxpayers or the business owners. Can there be a way out wherein the objective of the government is also accomplished, at the same time at the ground level compliance also could be easier and smoother? Probably government can come out with an integrator software wherein a QR code generation could be made mandatory with respect to every B2B invoice, just like we have e-waybill QR code. Similarly, we can have a QR code which is generated on every B2B invoices, and the recipients can scan it merely, so that all these 11 fields which are incorporated in that QR code can be translated into my accounting entry. Look at the process of ease of accounting also. At the same time, there would not be any of these typo errors or the human errors which would occur while keying in the data. If this could be implemented, I think whatever the matching concept which is being proposed could be wholeheartedly welcomed by everybody, which could lead to a ease of compliance without compromising on the tax seepage which might happen to the government. So, with this note, we would like to conclude over here that automation is the key for smooth GST compliances. So, do the technology optimization and do a happy compliance of GST. Thank you.